Hi, this Saturday we have two interesting webinars lined up for you. At 10 a.m. we have the age of asset allocation, and at 12 p.m. we have from miles away to Kodishwari exclusively for NRI women. The registration link are in the description. Do register and join the webinar.
How do tariffs affect your mutual fund returns? You might think, what do tariffs have to do with my SIPs? Quite a lot actually, because tariffs don't move trade, they move markets. And that means over time, they can impact your long-term CAGR. What do tariffs really do? Let's start simple. Think of the global economy as one big supply chain. Steel from China, chips from Taiwan, textiles from India. Everything's connected. Now imagine putting a toll booth on every border. That's what tariffs do. They make your goods more expensive to move, which pushes the costs for businesses. Higher costs means lower margins means lower profit. And when profits shrink, it eventually shows up in your mutual fund NAVs. So how does this play out in your returns? When tariffs rise, global investors get nervous. Markets tend to be very volatile, especially with sectors that depend on exports, like IT, pharma, auto. For example, during the 2018 US-China trade war, several global and export-heavy Indian funds underperformed the Nifty by 2 to 3% that year. Now, that may not sound huge, but here's the catch. Even a 1% dip in annual earnings growth can reduce your fund's 10-year CAGR by 0.5 to 0.8%. That's nearly 2 lakhs less on a 10 lakh investment at the end of the decade. That's how something as technical as tariffs can affect your compounding over time. But the good news is smart advisors know how to navigate this. They tilt portfolios towards funds that are driven by domestic demand. They focus on funds that have high quality and invest in those businesses with pricing power. Advisors also practice asset allocation, which can act as a hedge against any currency volatility. So, while headlines sounds dramatic, your advisor is already working to protect your long-term compounding. Now, what should you do as an investor? First, don't get distracted by short-term noise. Tariffs come and go, but quality funds will remain. Second, check your asset allocation. If you are heavily allocated towards risky parts of the market, you might want to get your portfolio reviewed by us. Third, stay diversified across styles, asset classes, and geographies. That cushions your CAGR over the long term. And finally, trust your advisor. So remember, tariffs may slow down the journey, but they rarely stop it. Your long-term CAGR depends far more on how consistently you stay invested and not on every headline. So, stay patient and stay disciplined. Keep working towards your next milestone. So, if you want to protect your long-term returns from tariffs, click on the description below and join Milestones2Wealth today.